In today's episode, we are going to be talking about what is an annuity and how does it work. We're going to be talking about the pros and cons of annuities. We're going to talk about a fixed annuity, variable annuities, index annuities, immediate annuities, deferred annuities. We're going to be talking about what to look for in an annuity. We're going to be explaining surrender charges. We're going to be giving different scenarios, like which scenarios work out better for different people. We're also going to be talking about commissions. How are commissions paid in annuities? So this is going to be an all-inclusive video as to what an annuity is and how does it work. To help us with that, we have Joe Yniguez. He works for Impact Leadership Network. Welcome to the show, Joe. How are you?
Hey, good morning, Jose Luis. Long time no talk, but long time good to see. Again, my name is Joe. I've been in the industry for about a little under 20 years now. I've known Luis for quite some time now, and you can ask a couple questions as far as annuities and how they work. But again, so we're not perfect strangers. I've been doing this for about 20 years, a little under 20 years now, and I started when I was 19. So one thing as far as advice I can give anybody starting in the industry very young is you can be a copycat as long as you copy the right cat.
I love it.
And then from there, whatever you lack as far as wisdom and experience, you make up with numbers, right? Just keep doing it more, keep pounding the phones, and keep getting the experiences that you need. And eventually you just get better.
So let's give the viewers what they want. Everybody wants to know, like, what is an annuity? And the reason I wanted to do this episode, I find that a lot of my clients, or I hear things like, oh, I'm investing in an annuity. And probably about 6 months ago, I had no idea what that meant. And then I started reading a book, Annuities for Dummies. And I started understanding it more. So now I'm better, but still not to the level that you are. So what is an annuity?
An annuity is just simple. It's a contract between you and the insurance company that's going to guarantee you won't outlive your money. So you can have a dollar or a lump sum amount that's going to go into a specific product or a contract, and the insurance company is going to guarantee you a payment for as long as you live. Now, every annuity has different caveats and benefits, and I call them bells and whistles. But typically, on the chassis of an annuity is typically anything you put into it will have a guarantee benefit. This is pretty much based on what you design and what you pick and choose. So you got to work closely with somebody to help you pick the right annuity first and foremost, because there's so many out there.
What I read in the book, and this helped me understand it, it said that an annuity is a combination between an investment and an insurance policy, basically. So it's a combination of it. So it's not strictly an investment and it's not strictly an insurance policy. So you get to decide, okay, how much of an investment do I want versus the insurance, or get to move different levers. Would that be like a different way of explaining it as well?
The key way you said is levers. There's always levers. Remember, you pull one, you push another one, okay? Annuities are very unique. There's so many out there. And I'll kind of give you the backstory. Back in the day, annuities had a bad rap. I'm talking about like 60s, 70s, 80s. And the reason why is because in order for you to actually qualify for the annuity and use it, you would need to annuitize it. So back in the day, most people had an idea that annuities were bad, okay? But consider this. Everything's changing. It's like you going to the Apple store, okay? If you want to go for the iPhone 1 and go to the Apple store and ask for an iPhone 1, will they sell it to you? Absolutely not. And the reason why, because everything's progressed so much further. And the reason why annuities have a bad rap back in the day is because, one, there was a lot of fees. There was very high commissions in those products. And the last but not least, if you didn't use the money in the time of you using the money, you lost the money to the insurance company. Pretty much like gambling. So you gave the insurance company $100,000. They grew it for a certain amount of time. You decide to start using it for income purposes, and guess what? You pass away. Who keeps the money? The insurance companies, right? So that's how they work. But let's start fast forwarding towards the future. Right now, there's something called the baby boomers. I'm sure we're familiar with them, right? So there's a giant influx of wealth coming in. We're talking about trillions of dollars being left in these certain accounts. Insurance companies kind of got the idea where, hey, we need to start making these products better and making them more efficient for the client themselves. So from the beginning to now, annuities are now offering so many benefits that, you wonder how you can get some of the benefits that you have inside of annuity as far as guarantees, guaranteed income, bonuses, living benefits. They give you riders where they multiply if you get sick. So if you're getting an income already, they'll multiply it as long as you're meeting what's called the ADLs, actions of daily living, activities of daily living. If you miss 2 of them, some annuities companies actually double the income you get per year just by meeting those recommendations. But again, like Jose said, there are levers, and there's no free lunch, right? The fees are there when the benefits are there, right? But again, right now, as far as annuities go, a lot of annuities are anywhere between 0% as far as costs and fees, all the way to 1.1% to 2% on the fixed side, on the index side. On the variable side, Those are different animals, anywhere between 3, 4, 5%.
Let's start off with the basics. When you said annuitize it, what does the word annuitize it mean?
It means now you start leveraging, you pretty much give the money to the insurance company, and they now, you pretty much exercise your right to start pulling money out. So you pretty much lock it in, and you can't really take it out at this point.
At
If
that
you
point.
do, there's a lot of fees, and there's a lot of fees and a lot of other things that happen with those annuitized
And
contracts.
that's how it used to be. You could still
Hmm.
do that, but
Yeah,
you're not required to do that anymore, basically, is from what I'm
correct.
understanding of it. So you can
Correct.
basically have an annuity and not annuitize it. And eventually you can, so if you have an annuity and you're not annuitizing it, it's almost like you're just growing it basically at that point.
Hmm.
And then if you
Right.
choose to annuitize it, that's when you choose to make it into like an income stream, if I'm understanding correctly.
Correct.
Okay,
Correct.
got
So
it.
you're not locked in. After your surrender schedules, you can move your money back into an IRA if you wanted to. It's pretty much your money, do what you like. Now, I know you mentioned there's a lot of different kinds of annuities, so I'll kind of, once you touch upon them, I'll brush up on every single one of them if you like.
Yeah. So let's do this. Let's start off with like what is a fixed annuity? What is a variable annuity? Index
Mhm.
annuity, immediate annuity, and a deferred annuity, and how do they like vary from each other?
Okay, a fixed index or a fixed annuity are very simple. There's really no crazy components to it. They're typically called MIGAs, multi-year guaranteed annuities. A lot of these insurance they're advertising a lot of high return annuities with minimum guarantees. So, for example, you can actually get a 3-year MIGA multi-year guarantee annuity, lock it in at 5%, and you'll get 5% for the next 3 years compounded inside of a fixed index annuity or a fixed annuity, right? So there's a couple of key benefits to it. They do have some liquidity. Some annuities give you what's a 10% withdrawal per year after the first anniversary year. But typically on a fixed account, you're either going to a fixed strategy account. That means you're going to get 5% as long as the money's in the account, or 3% as long as the money's in the account. Or you can go to a multi-year guaranteed annuity where they guarantee you a 5% for the next 3, 5, or 7 years. So if inflation starts to go down and rates start to go down, guess what? You're locked in, right? If interest rates go up while you're inside of the annuity, you're locked in at that 5%, 5.25. I've seen them go up all the way to 6%. So if you're looking for a 6% compounded growth, multi-year guaranteed annuity, you can put a sum of money, guarantee a 3, 5, or 7 year 5% guarantee on that specific annuity. On the fixed side, they'll fix for a purpose, a set amount of time, which is a surrender schedule. Up to 10 years, they'll guarantee you a minimum rate. But since I think we're in different times now, Jose, so interest rates are increasing, so insurance companies are really being competitive as far as interest rates inside of an annuity. But typically, that's how a fixed annuity works.
Basically, so they're giving you a fixed return basically for a
Hmm.
fixed period of time, basically, if I'm
Right.
understanding correctly. Okay, got it. Variable.
Variable contracts are very unique. I used to sell those quite a bit back in the day. I no longer do that, but they're called high watermarks, right? So let's just say we actually grow your account to a certain dollar amount and the market falls off. The insurance company is going to guarantee that income space that you have. We're going to base your income on that highest watermark, all right? But the unique story here in the market, if the market decides to perform and you hit those watermarks every quarter, every year, every month, however it's designed, you're gonna lock in on the variable rate. So you have the benefits of being in the market, and you have the benefits of getting the guarantees on income when it comes to a VA, variable annuity. So they're wonderful strategies. Again, one comes with more risk and more fees. If you ever want to liquidate the actual account itself, you would liquidate it at the market rate at that point, or you can pretty much take the income guaranteed for life. So you get the best of both worlds.
You said something about liquidating. Let's talk about, and then we'll continue going down the other ones. What is a
Mhm.
surrender charge, and why is that important? And what is normal as it relates to a surrender charge, and what is not normal? And why do insurance companies do this as well too?
Well, insurance company is going to give you all the benefits as far as guarantees. Most people, if you look at your investments, your traditional investments, you can't get guarantees. There's more people that are at the age of 60, let's say 55 and 65. They're not looking to get, home run hits in the game anymore. They're looking for singles and doubles, right? So they're looking, how can I ensure I don't risk or hedge or pretty much mitigate the risk of me losing my account? So, for example, if you're 60 years old, you're trying to retire within the next 2 years, you can't afford to take a 20% pullback in the market, right? So what the company is doing, or the insurance companies are doing, is they're giving you protection from the market. They're letting you participate in the market, but the only thing you're sacrificing between now and then is commitment. Okay. So don't think of the word surrender schedule as time, which it is, but it's a commitment between you and the insurance company that you're going to leave your money there for a certain amount of time. At the same time, they're going to give you the perks of growing your money, protecting your money, and when you decide to use it, you can either use it in the form of an income guarantee or just an accumulation strategy where you walk away with your account. And I do both. There's clients that say, "Hey Joe, instead of me putting my money into the bank, I like to actually earn the same protection and guarantees, pay zero fees, and I want to accumulate my account for the next 3 to 5 to 7 years." Perfect. We can actually do that. That means they get no income benefits. That means there's no cost to the actual annuity itself. They pay zero fees, but they get participation in the markets or mirrored markets like the Nasdaq, the S&P. They can even put money in gold, different stretch strategies that exist all inside of each annuity, and that's why every annuity has a different set of indexes that can help you grow your money while you're inside of the protection of the annuity.
It's almost like a prepayment penalty on a mortgage, if I'm
Correct.
understanding correctly. Like you prepay your mortgage. In commercial, this is very common. So
Right.
you take out your money in advance of whatever contract you have with the annuity. You pay
Right.
a fee as a result of them. What do those fees look like? Are they like 1%, 10%, 20%?
They're on a descending scale. So typically, the longer the annuity term is, which I recommend staying away from long term annuity contracts. Anything over 10 years, you're kind of locking yourself into that contract, especially with that annuity contract. And I can tell you right now, there's customers that annuities have evolved so much that they're still in a surrender schedule that the other advisor put them in so many years ago. They can't take advantage of the new products today, right? So you want to look at anywhere between 9 and 10 years and lower. Okay, and you want to make sure that leverage better annuity contracts that do come about. Now, as far as comparing it to the to a descending scale, so year one is going to be the heaviest part. So if you put your money into an annuity, year one, if you decide to take it out, man, you're going to pay anywhere between 10, 11, 12%. Okay, on specific annuities. Some annuities, they're 7 year contracts. They go 7, 6, 5, 4, 3, 2, 1, 0. On a 10 year, they might be 11, 10, 8, 6, 5, 5, 3, 2, 0. So they all have different surrender schedules. And this would be something I would definitely ask the person if you're talking about or thinking about annuities. What is a surrender schedule? Heaven forbid I need my money. How much can I take out? What's my liquidity benefit? So again, it's an ascending scale that fees do go down as long as you're inside of the annuity. And as time continues, they just get lower and more favorable.
Yeah, it's funny because that's the same thing with commercial real estate. Like if you get a commercial loan, year one is 5%, year two is 4%, year three is 3%, and two and one. That if I prepay it in year one, I have to pay a 5% fee for that entire loan amount for
Right.
prepaying the payment. So it's very similar. So let's keep going down the list. Index annuity, immediate annuity, and
Yeah.
deferred annuity. But I felt like it was important to talk about the surrender because we're talking about just
Right.
withdrawing the money at times, you know?
That's just raw cost, man. So as far as like business goes, you're pretty much putting your money where you're guaranteeing it. So mind you, like I said earlier, the benefits are there if it's suitable, right? So one thing, a lot of times when I talk to a client, I have to make sure the annuity is suitable for you. I got to take inventory of what you owe, how much you make per month. Heaven forbid you need the money sooner, you're not going to need it from this. Okay. And they work like any other retirement account. There's something called qualified and non qualified. So I want to make sure I get this in as well. So qualified money, both you and I know, is tax deferred money sitting in 401ks, especially money earmarked for retirement. Okay. Non qualified would be money from liquid stocks, mutual funds, money markets. Anything that you can actually pull and use that specific day is considered non qualified strategies, right? Annuities work for both. As far as indexing strategies, you can use both for, and these are probably my favorite. And the reason why is because they are very simple when it comes to what they do. You have indexes, you can pick 4, 5, 6, 10. Okay. Typically 30, 25, whatever you want to do, you can diversify between a set of indexes with inside the company. So, for example, I work with one company, they give you the option to have an 8.25% gold option. You can invest in a Nasdaq. You can invest, or you can put your money and have it mirror the Nasdaq, mirror the gold index, mirror the S&P, mirror the Barclays. Okay, so all these accounts work where they're based on a point to point, or they take an average of what happens throughout the year. So typically, index annuities have very flexible terms. I've seen some go as 5 years, 7 years, 9 years, 10 years, and further. Okay, and you can keep them very inexpensive because if you don't add an income rider to them, there's no cost to owning the actual index annuity, right? But now your index annuities pretty much leveraging whatever these indexes do. And at the end of the year, based on your anniversary date, they're going to take an average or a point to point and credit your account based on what it did. So, real life example, I actually had a client made 19% in their fixed index annuity within the last year, and another 8% in different indexes, and one index earned zero. But then sometimes zero is your hero and you don't lose anything inside of the index. So again, if you can put your money where you have zero loss, you can manage or get decent rates of returns. Remember, you're not looking for home runs. We're looking for singles and doubles, but occasional home runs here and there. And you want a death benefit, which means, heaven forbid, something happens to your person, your money goes directly to your loved ones. And this is the reason why annuities are so important, because they have a death benefit. They automatically avoid probate. So if you don't have a trust or a will, and mind you, I'm not a trust or wills attorney, but your money, if something, heaven forbid, happens to your person, it goes to your loved ones and it avoids probate automatically. So you're not sitting in a position where you're worried about, hey, this is money sitting in probate. Another reason why index annuities are so unique is because their costs are virtually not there unless you add certain riders, certain fees. Now, inside of index annuities, there's a couple things you have to look out for. I call them caps and spreads. These are all sneaky words for fees, right? So a spread is anywhere you look at the account and say, hey, pretty much look at it this way, Jose. If I'm buying an S&P strategy or a NASDAQ or a Barclays strategy, and there's a spread of 3% or 2%, that means I need to earn 2% to cover that spread before I can actually get into the meat and potatoes, before I start earning an interest rate on the account. Okay. Another thing I would look at is participation rates. Okay. A lot of companies change their participation rates as time continues. And I'll tell you what a participation rate is. So let's just say year one, you put your money into an index strategy, an index annuity, like we talked about, and that gives you a participation rate of 150%. So if your account makes 10%, you get 15%, which is great. But the following year, the insurance company, based on what's happening in the economy and financials, everything, they can reduce that participation rate down all the way to 60 or 70 or 80%. So you're still in the same index, but you're participating less. But the first year you participated more. So I would make sure and ask an insurance company or annuity company, hey, how often do you change your participation rates? That's a big question. A lot of them are pretty strong. I know quite a few companies are very strong with their participation rates. They don't change often. Another thing is indexing or point to point, and then cap rates. Cap rates are unique. That means you can only earn up to a certain percentage in the cap per month. So let's just say the cap rate's 1%. Okay, and let's think there's 12 snapshots in a year. On that specific date, on your anniversary of every month, they're going to take a snapshot of the market and say if it did more than 1% or less than 1%. If it did less than 1%, guess what? You lost nothing. If it did more than 1%, guess what? You got the 1%. Well, if the market did 15%, you still got the what? 1%. So now if you add those months together, based on the 1% or 1.5%, some cap rates are pretty good. They're 2.5%, 3%, 2.75%. So just keep for sake of math and keeping it simple, let's just say the cap rate's at 1%. If we get over 1% every single month, guess what we get? 12%. And that gets credited to your account. If the market only did 6%, which means it had a couple days or on your anniversary day, it did negative percentages, you didn't earn 1%, guess what you get? You get the percentages you did get, or you get a culmination of them. So again, it's a very unique way of doing it. So spreads, cap rates, and participation rates are what I would look out for when it comes to purchasing an annuity. Next would be time frame, if it meets your time frame or your investment time horizon. So again, to go back into index, there's so many things you can do. If you wanted to add a rider into your index annuity, for example, remember the three-legged stool we always talk about in finances? We talk about insurance, pension, Social Security. Now, pensions, where are they at today? They don't really exist. The last person I know that has a pension is my grandmother and my grandfather. My grandmother worked for Nabisco, those little cookies?
Yeah.
She worked for Nabisco. She ended up walking away with a Teamsters pension, and she was like the last year that got to keep their pension. She was picketing, doing the whole thing. Number two is Chase Bros. My grandfather worked for Chase Bros. He got a pension as well. But those pensions also created what? Healthcare alternatives. They gave you guaranteed income. So pretty much they paid you 80% of the maximum income you made while you're giving your service to the company, right? Nowadays, what do? No more pension plans.
Yeah.
We call them 401ks, 403bs, TSAs, FERS, PERS, STIRS, KEO, SEPs, Simples. They all work the exact same way, where they give you a defined benefit, where they guarantee you money, and they put in money while you're working there, and they match you. They're called matching retirement
Yeah.
accounts or deferred plans. Um, so now you're sitting here where what happens now? So now that you retire in 30 years, people are looking for what? How can I guarantee my money? How can I guarantee I'm not going to outlive my money? So this is where perfect index annuities come in, where you can say, hey, what if I can eliminate the risk, still have you participate in the market, defer the income, at the same time, I can get you a rider that's anywhere between 0.95 to 1.10% on fixed accounts. Haven't seen them more than that. And they guarantee an income for the rest of your life. And the way they work is they'll say, for example, I have a company that I know, everybody probably knows it pretty well, but a lot of people don't know about these index annuities. They give you a 30% bonus for rolling your money in, just for moving your money in on the income side. There's other annuities that actually give you an 11% cash bonus. That means they give you an actual cash bonus on your actual account, and they grow that dollar amount. Okay. So the reason why this is so important is because now you're putting insurance on your retirement or your 401k deferred assets, but you're not relying on a personal pension plan. Number two, Social Security. Jose, for you and I'm not sure if it's going to be around or what's going to happen there, but for people that are of age, guess what? This is a way of supplementing your Social Security with guaranteed income. And last but not least is making sure some people, if they're investing in the future, to talk to get another stream of income by creating another strategy. And typically those other strategies, we can actually help them out with those as well. But the idea is having three: a pension plan, a Social Security, and a personal savings account. But we're actually covering a couple of them with just an annuity itself, because we're guaranteeing assets, we're protecting money, and we're not worried about the market. It's kind of like a hands-free approach to landing in retirement. And this is a great way
Yeah.
of doing it.
So it's basically a way for, like, let's say that when the stock market crashed in 2008, like, and let's say that you were retiring in those years, or then your 401k dropped in half or dropped
Mhm.
significantly. So it gets to a certain point where at a certain age where some people can't afford that to happen because they're relying on that money or that income to be able to live for the rest of their days. So what it does is it gives you guarantees, but with those guarantees, there's come fees as well too.
First and foremost, those fees are typically in a 401k. There's a lot of fees you don't see. People say, well, I look at my statement, I don't see any fees, but you don't see the custodial cost fees, the 401k, the
The back
administration,
end fees.
401c, the back end fees. You don't see that on your report. I believe there's a Time article called Sink the 401k or Time to Retire the 401k. We all know fees eventually eat away at your personal investment, right?
And they
So
compound too.
they compound too. So they don't just take away the small part of what you put in, take around they take in consideration the whole value of the account, because they grew the account to a certain percentage inside of a house. Now, inside of the house called the 401k. Now, in an annuity, guess what? You can either go, if you're 8 to 10 years before retirement, say, hey, Joe, I want to grow this income specifically for guaranteed income I can pull out. And if I can show you, and one thing I am in, Jose, I'm not into the what game, I'm into the what is game. If I could show someone, hey, minimum guarantee, if you retire in the next 7 to 8 years, I'll guarantee you through the insurance company XYZ dollar amount guaranteed per year.
And
Pretty cool.
that's what people like at that stage in their life. They want the guarantees. They
Yeah.
want to do it. I've heard too that something about a mortality pool in the book. They talked about it, that, like, meaning, like, let's say that I only have a certain amount of money, and that money under a normal annuity couldn't guarantee me a higher amount, that they'll do like some sort of mortality pool where a bunch of people pull their money together, and then basically it pays me a higher income, but it takes income from the people who passed away earlier and left their money in there. So it was like, it sounded earlier like older annuity. Are you familiar with
Yeah.
that at all? Or
Those are, I'm not familiar with that. All annuities typically work like in a contract between you and the insurance company that guarantees you won't live your money. That's the basic structure of an annuity and how it works, right? So now, as time continued, things got better. So now, what annuities are doing, they're giving you those benefits and guarantees,
to the
putting
family?
your money into different indexes, and it's your money. If something, heaven forbid, happens to your person, guess what? That money goes back to your beneficiaries with a death benefit. Back in the day, it would have went to who? The
The
insurance
insurance
company.
company, basically.
So now it's a different way of doing business today, because these are so flexible. Inside of index annuities, they provide you the guarantees. And you asked me like earlier, who do they benefit? I have clients that say, hey, Joe, I want zero to do with the market. I don't care what interest rates you're doing. I don't care what anything's doing. I want my money not to lose money, and I want it specifically for my retirement. What can you do? Great. We'll go with no cost. We'll diversify with the best indexes they have, and we'll let it go for the races. So far, they're making anywhere between 3, 5, 6, 7, 8, 4, 4, 8, 2, 4, 8%. It's all compounding, it's all protected, and it's all earmarked for retirement inside of an index annuity. And these are people that are younger. I'm talking about people. I recommend people, if you're young, you have the time horizon, get into the market, do what you have to do, embrace the time, embrace the lumps and whatever's going to happen, because you have time to recover, right? But there's some people that say, hey, I want to earmark this money. I don't want to lose it. I want to grow it with zero risk. Great. That's the perfect strategy for them.
Now, what I wanted to ask you, like, and it's funny because recently I went self-directed on my 401k,
Mm-hmm.
and the reason I did that was I think on average on my 401k was earning like 6.5%, but I didn't really feel like it was growing. I'm guessing, if I had to take a guess, it was some of the fees going on in the background that you don't really see. So, like, yes, I'm getting 6.5%, but what if on the back end it's 1 to 2% in fees? The reality is I'm really only getting 4.5% because they're taking that. So when I hear this, and I had a client tell me, "Hey, I'm being guaranteed an 8% in an annuity."
Mm-hmm.
What does that really come out to after the fees on the back end? Is it like 1%, 2%, 3%? Are they really earning 5%? What does that look like?
On the 401k, it's a simple where we go back to the beginning. That's called the spread. Okay. So the spread you have is before you pay the fee, and then you get to the actual meat and potatoes of it. But you're paying a spread anywhere you go. It's typically a fee, right? But as far as where the fees are on some index annuities, there is no fees if you have no additional riders to the account. If it's just a specific savings account that you're using an annuity for, and you're using index strategies inside of the annuity, you can have zero fees into the account. As far as the fees that you pay on the back end, I haven't seen any fees on the back end. Pretty much, which when you get your annual statement, it's going to show you got credited this amount, and it was credited to your account, and that's it. And it resets every single year.
A rider is a guarantee, right?
Yeah. So
Got it. Let's get into the commissions portion of it.
mhm.
Which one of these has the highest commission for people that sell annuities? Like, is it a fixed annuity, a variable annuity, index, immediate, deferred? Which one has the highest fees?
So before I get into that, I just want to give you a little case study of what I worked on, because that's an important question, I said, but I want to make sure we understand what the riders are. So, for example, I had a client. Okay, she is 68 years old.
Mm-hmm.
Typically, when you look at a 401k or a whole portfolio picture, they call it the 4% rule, where you could take out 4% every single year without interrupting the principal and actually continue growing, living on the interest. Okay.
Mm-hmm.
That was a great rule like 20 years ago. Today, things are changing so fast and so quick, where people are saying, hey, that 4% rule is not enough for me to maximize my retirement. So, this lady, I ended up running an illustration for her. She's rolling around a little under 400,000 in the account. So the insurance company is going to say, hey, at 68, 69, when you decide to take out income, we're going to guarantee you an 8.5% guaranteed for life, which is better than what? The 4% rule. Not only that, in the next 2 to 3 years, if she ever ends up getting hurt, okay, so let's just say she's getting a guaranteed income of, let's say $40,000 a year. If she ends up needing this benefit or the living benefit, and mind you, she's paying 1.01% for the actual rider itself, they're going to double this income to $100,000, or let's say $80,000. So they'll go 40 and they'll double to 80 for the next 8 years. If she's still around after that point, they're going to reduce, after the 8 years, they're going to reduce that income back to the $40,000 guaranteed for life. While most people would have exhausted their accounts within the next 10 years, it's going to continue going for the rest of her life. Now, one thing I will teach about annuities and about general wealth, if your wealth is not in line with your health will eventually take your wealth. This is a way of protecting you from that happening if everything meets what you're suitable for. Now, as far as commissions, they're very unique. Any contract, like right now, I'm actually working on an annuity contract for a 93-year-old woman. The commission on that is 1.5%. Not bad. So I roll in $100,000. They give me $1,500 in commissions minus my contract. So I'm making an extra $1,300-1,400 just by helping that client roll that money over into an account. Now commissions go all the way up to 7%, and I see them go even higher than that. Okay. So the unique story here is that when a client rolls their money into an annuity, you're in a certain amount of time. Okay. So the insurance company is doing what? They're buying long-term assets. They're buying future assets. They're playing with their money. Meantime, They're letting you have access to all these index strategies and crediting your account. So on the commission side, if you roll in money to an annuity, okay, instead of you paying a fee for rolling your money in, so if you roll $100,000 in or 50, whatever it may be, may have you, right? Whatever you like to roll in or whatever's suitable for you to roll in, you'll never see a commission taken out of your account. You'll never see, hey, if it's a 5 or 7% commission and it's $100,000 rolled over, just for simple math, you're not going to see $7,000 missing up front. You'll see your original 100,000 into the new account for 100,000. The only difference is now you're committing to 7, 8, 10, 9 years, 10 years for you to stick with that annuity contract. So that's the commitment you pretty much pay for.
So would this be safe to say the longer the commitment period, the higher the commissions? Or why are some 1.5% and some of them 7%?
Well, for example, we talked about mortuality tables, right, earlier. So the 91-year-old client, the chances of something happening to her are a lot higher.
Higher.
And she's not going to keep the contract for very, very long. The insurance company knows they're not going to hold on the money for a long time, so they're going to pay it back whenever she needs it or after the 1 to 3 year commitment is done. Okay? So obviously, the shorter the commitment, like you said, the less the commission, right? The longer the commitment, the more the commission. But there's a lot of key principles that come along with that. But just to keep it very simple, yes, the longer the commitment, the more the commission.
If I die and there's a high surrender charge, does that surrender charge still get charged, or what happens in a situation like that?
That's a great question. The fact that you died, the money all goes back to your family in the form of a death benefit. There is no surrender.
There is no surrender at that point,
There's no
basically.
surrender.
So,
And you can also avoid a surrender. You got to make sure your annuity has this key benefit as well. If you get admitted into a home, if you get admitted to, critical care, something happens to you for more than 30 to 60 days, some companies have 90-day provisions, your money can actually be pulled out the annuity without paying any surrenders as well. So those are key benefits you need to look out for. And there's so many. That's why you got to make sure you talk to a professional that's been doing it for quite some time and doing it for a while and that understands the differences between all the annuities and then finds out what's suitable and actually works with a back office that does monitoring, where compliance checks and everything's done to make sure this is a suitable recommendation. And Jose, I've done it by myself, where if I'm an independent agent, I worked for myself for many, many years. I worked for a broker dealer many, many moons ago, and then they took a lot of the commissions I made, and I didn't know because I was so new and so excited and fired up. I didn't read the fine print, and then I went independent for about 4 years, a little under 5 years, where I was just making 100% of my commissions. And then you need to just find a right practice where you get the mixture of both teamwork, commissions, back office, and everything. So again, I think someone with a back office and a team and more heads than one are going to help you make the better decision when it comes to making a recommendation for a client.
how is it that the commissions don't show on the actual balance? Meaning, because like let's say it's a 7% commission. How is it that if you look at your statement, it doesn't say $1 million minus 7%? How does that work? And this is good for consumers to understand that. And is it a good question to ask your advisor, like, hey, just out of curiosity, like, how much commission are you making on this, and how much commission are you making on this one on the back end as well too? Is that like uncommon, or is that a good question to ask as well too?
That's a great question. There's different types of commissions you can collect on an annuity, right? There's A, B, C, and sometimes option D. Okay, A is what? All up front. Give it to me now. Let's all get it, right? And there's no waiting line here. That's option A. Option B is you want half up front and the rest divided into quarterly benefits. Option C is I don't want the commissions. I want that commissions to pay me for a long duration of time. So you're looking more at the residual play, right? And option D, you can go in the management, whatever you want to do, and definitely leverage the different other strategies that exist that you can pretty much identify how low you could take less commissions and get it for a guaranteed lifetime. But again, that's also risky too, because eventually annuities, they're out of surrender and the clients actually move the account somewhere else, right? So there's different ways you can get your commission as far as how that goes. Now, as far as how the company gets me paid or I get compensated, they compensate me on the time that you're leaving your money in there. Because mind you, while you're leaving your money in there, they're making money. Insurance companies are not stupid. They're not like banks, all right? Right now, there's $1.15. So I want you to see the power of why annuities are so unique, right? If you go to the bank, there's something called fractional banking, which means they're loaning 90% to hold 1% or 10%, right? In an insurance company, there's about $1.15 for every promise they make. So every death benefit you see for $1 million, 500,000, or annuity contracts and they guarantee you, there's $1 backing up that promise. Okay. Now, how we get paid is perfectly. All it is pretty much the time and duration you're in that contract. You're not going to see how much they get compensated because it's not reflected into that. The insurance company's paying me on the back end to pull you in as a customer. Okay, so even if and then if you do leave the contract early, guess what? There's a surrender schedule that covers they're compensating me, and then it covers them for what they put in for the underwriting and all the costs and closing down the long term strategy they put in place for you. So I'm not sure if that answers your question, but yeah, everything's built into the time, the surrender schedule if you leave early, and then how much they're actually making on the back end. Insurance companies are making big plays. They're multi-billion-dollar companies, and guess what they're doing? They're putting their money in high-yield strategies. They're buying treasuries. They're doing everything they can, mirroring the same indexes you're getting. They're also participating in higher market, more risk strategies that are safe to them. At the same time, letting you compete and play with them as well. You're also getting the benefits from putting your money into a fixed
So,
annuity.
so this is what I've heard. I've heard that, like, let's say I get $1 million policy, and
Mm-hmm.
it's 7% commission, that they get a loan against the whatever the annuity, and that's how they pay the annuity on the back end with that loan. But that's how it doesn't show on the actual statement, because it would look very funny if you put $1 million and all of a sudden there's 7% missing.
Right.
People would be like, why is this missing? So something along those lines on the back end,
Yeah.
where people don't actually get to see that part of it. Now, we talked about like a guaranteed 8%. Let's say that I'm indexing a mutual fund. I
Mm-hmm.
still have the fees of the mutual fund, right? Like, meaning, like, if the mutual fund has like a 1% fee or a 2% fee,
Right.
I'm still like, it's 8% and then minus those fees as well too
Mhm.
that are in the mutual fund, right?
So now we're going into what's called variable annuities. Okay,
Variable. Okay, good.
variable annuities.
Which we
So
haven't
variable
gone into.
annuities now you can pick and choose the funds you want inside of the VA. Okay. I won't speak too much about it, but there is something called open architecture where you can pick the same fund accounts you pretty much like. If it's the S&P, if it's ETFs, you could put them all inside of an annuity contract, right? And then if you add a rider to it, you're paying anywhere between 2 and 3%. But you're also paying for the cost of the actual funds you're putting inside of your annuity as
And is
well.
that yearly, or is that like
It's
one
annually,
that's yearly, right? So if it's
annually.
guaranteed 8 minus 1 or 2 or 3, then it's really a 5% or a 6% or a.
They're going to charge you based on the account value because, like we talked about earlier, there's two account values. Their actual account value that's in the market, that's working in the market, and then when you just choose, and then let's just say the market value does go really high, and at that point, the insurance company you're with or the variable annuity company, they lock in that dollar amount. So let's just say the market goes back down. What you're paying for is that rider. So at one point in life, if you're 62, 63, 64, and you want to start retiring, the old traditional way, you would retire or start pulling money from the lowest part of the market where you are. On the VA, the variable annuity, guess what? You could start picking from the highest part of the market and guaranteeing an income stream off of that dollar amount versus this dollar amount. So you're
Mhm.
paying for the guarantee of income, but you're also participating in the market, and you're also pretty much paying the fees that have these strategies work in your benefit.
What is an immediate annuity versus a deferred annuity?
An immediate annuity, typically we call those SPIAs, single premium income annuities. Okay, that means the client's like, hey Joe, I want to make sure I put my money in, and then my job is to find the highest paying annuity based on age and when you want to start taking income. So, for example, I had a client that said, "Hey Joe, if you can get me 10 grand a month from this dollar amount, let's do it." Okay, so I found a SPIA that was going to guarantee you that dollar amount guaranteed for life. So let's just say she lives from now to age Yoda, right? She's gonna get a guaranteed income for as long as she lives. If something heaven forbid happens to her during that time frame, guess what? The annuity company gives the family of the beneficiaries back that money in the form of a death benefit. So it's a way of guaranteeing income immediately. So let's just say a single premium income annuity would be, hey, this is the money I want to put in. Next month I want to start taking money out at a guaranteed income interest rate for the rest of my life. That's a single premium income annuity. That's an immediate annuity.
And then the deferred just basically means that you're not getting the income right away. You're basically saying, "Hey, I'm going to contribute to this for the next 10 years, and after that 10 years, I can determine whether I want to annuitize it or not," basically.
Two things there. On an annuity, most annuities are single premium, which means you make one premium in, and that's it, and that money works for you, and that's it. Okay.
Most annuities are like that.
Most annuities are single
So
premium.
so so just so I understand, that means like, hey, I'm putting a lump sum in like $1 million
Hmm. Hmm.
versus putting in $2,000 every single
Hmm.
month, basically.
So the way I would structure is, yeah, you put a lump sum of money in. So let's just say someone has there's two accounts. They have an old 401k from an old provider, right? That old 401k has just been sitting there. It's done really well. It's grown. How about we protect that? Guarantee the growth. While you have your new job, still contributing to your new 401k as if you were, let's go ahead and talk to another person and start another Roth IRA. Let's start something. Let's start adding. Let's start creating a portfolio around you. Okay. But this money that you've grown for the last 10, 15, 20 years, let's go ahead and protect it. And since you're about 10 years from retirement, we're going to put everything we can to make sure this money grows while you're still participating in your current work environment. And let's add a couple more benefits to it so you actually have a well-rounded portfolio. And then we get into trust, life insurance, and everything in between. But again, the goal is to make sure you have a strategy that you have in place that's protecting your heavy load money, your working
Yeah.
money, all right? And then avoiding any kind of risk or mitigating loss and deferring it for as long as you can. Now, with more deferral comes more benefits. There's companies out there, I like to say names, but I'm working with a lot of these companies. They'll guarantee you 8% compounding for the next 10 years. So you're on your income side, which means you roll your money in, they'll pretty much they're going to give you a 30% bonus for rolling your money in. These are riders. You roll your money in, they give you a 30% bonus. Great. You got a 30% head start on your portfolio. The longer you defer, they're going to guarantee you 8% compounded for the next 10 years, guaranteed. Then you can turn on income there and get the dollar amount you want, guaranteed for life. For some people, that's a straight valuable tool to help them catch up on what they missed. If they hit a bad bump in the market, you can really make up a lot of ground by those kind of benefits. There's a lot of other annuities that offer more bonuses, but again, they're all levers. All right, there's a lever to everything. So again, if you want to get into those nuances with specific annuities, yeah, there's different tools, different ways of doing it. But at this point, it has to be suitable. I have to make sure the client understands it, and I have to make sure that it's actually something they're going to benefit for. And if I can change it within 5 or 6 years, I'll pick the shorter term vehicles to grow the account and eventually leverage higher guarantees
So
that
what you're
benefit.
saying too is that somebody can roll over a 401k with a previous employer basically,
Mm-hmm.
instead of making it like self-directed, they can roll that over into an annuity basically is
Mm-hmm.
what you're saying
Correct.
as well
Correct.
too. Got it. And
Correct.
and is that qualified or non-qualified, or what was the difference there? Or
Any deferred account specifically earmarked for retirement with deferral is going to be qualified money.
qualified money. Got it.
Qualified money.
Okay.
Non-qualified money will be any stocks, bonds, anything that liquid you can call that day. You can use that money as well. Now, this is the caveat to that. There's individuals say, "Hey, Joe, I want qualified money. I have non-qualified money in my checking account, and I want to move it into an annuity." And to kind of break it down, in a checking account, you're not getting high interest rates. But let's say you have it into a money market like most people are doing today. They're getting 3 to 4 to 5 to 6%, right? Or you can go ahead and invest in treasuries. It's all your call. But let's just say you're going to the bank, you're earning 4%. Okay, that's a great strategy. The problem with that, after a certain amount of time, if you're in that wealth gap, you have to pay capital gains on that money. Okay, every year you pay capital gains on the money you grow inside of a fixed account. So it might not be the best idea to keep it there. Instead of an index annuity or a fixed index annuity or a MIGA multi-year guarantee annuity, you can roll that money in, and that 5% compounds, and you pay no taxes until you touch it. Make sense?
Got it.
But the
Yep.
problem with that is that now you turn that money into tax retirement money. So if you want liquidity and you want to turn this money into something that you can touch it in the next 5 years, have guarantees and compounded returns, it's best to do it in your later years when you can actually touch this money. So someone that wants to defer their money for the next 5 years, earn 5 or 6% guaranteed compounded, great. By the time you're 59 and a half, you can now touch this money and there's no issues, right? If you're young and you want those same guarantees, if you put your money into a non-qualified fixed index annuity, you automatically earmark that money for 59 and a half money. Because if you take it out, you got to pay a penalty. 10% penalty. Pretty much you treat it like retirement accounts.
What is a lifetime annuity versus a term annuity?
The lifetime annuity is a guaranteed income annuity for the rest of your life. Now, I have term annuity. I would tell you it works like this. If I can give you a term annuity example, they're called 5 year certain level or 5 year certain, 10 year certain. That means if you can tell the insurance company, hey, I got $100,000, I want the money to guarantee me for 10 years. They're going to maximize the amount of money you can get and pay you that money. And in 10 years, done. No more money, no more nothing. But the beneficial thing there is that most annuity companies actually offer what's called a death benefit. And for some people, and this is the key caveat too, Jose, let's just say you can't qualify for life insurance. You take your labs, you take your medicals, you talk to the doctor, you get some kind of critical, crazy disease. The insurance company can no longer qualify for life insurance. Guess what you do? And you do have assets. The next thing to do is actually create a strategy where the benefit inside of an annuity is the biggest benefit is a death benefit. So you can turn this money into instead of buying an insurance policy, you can turn your money into an insurance policy that directly goes to your family and avoids probate as if anything else. But again, it's a way of creating capital into a death benefit that has a pass through.
How do you select the right, like, so when I get insurance on my home, different insurance companies have different ratings. They have
Hmm.
like A rating, double A or triple A or
Hmm.
whatever it is, which just basically means that they have better financials, to
Hmm.
say the least. How
Hmm.
does that work for annuities? Are there different companies with different ratings? And how does somebody
Right.
select? Because I mean, if somebody's guaranteeing an income, is there a chance that that company could go bankrupt as well too? And then what happens to that guarantee? And how are insurance companies
Hmm.
backed to decrease the chances of this happening? And has this ever happened as well too?
No. Insurance companies have they have tri insurance, which means they have insurance companies on their insurance companies. And mind you, to be an insurance company, you have to have enough assets on hand to make a deliverable promise. So I don't see insurance companies going out of business. I see insurance companies either getting dissolved and getting picked up by another insurance company. A long time ago, I believe I sold a company called Aviva. Aviva was just an annuity company. Aviva, unfortunately, didn't their financial. I'm not sure what happened to them, but then a bigger company named Athene picked up that actual contract, and all the clients within it honored their commitments. And the reason why I can say that because I actually got my parents into a Aviva policy many many years ago. So Athene purchased them. They maintained their same contracting commitments, and then that was pretty much the end of that. So instead of it being Aviva, it was now Athene. Okay, so these insurance companies have tri insurance or insurance on themselves, and there's actually a dollar. There's actually another. It's an agency, an insurance company, or an annuity company, or insurance companies are a part of, where they back each other up. Heaven forbid something were to happen. Guess what? They have insurance on their insurance. So it's crazy how that works, but again, it's probably one of the safer ways of putting your money away, where you can actually guarantee and bet on those guarantees.
Do they have ratings as well too, as it relates to their financials? And if so, I don't know if you would feel comfortable sharing what some of the companies are with the highest ratings, or if basically what to look for when basically
Mhm.
talking to different advisors.
Right. There's a companies. And the thing about look at it this way, Jose. A lot of people don't understand how annuities work. Never been exposed to annuities. Companies out there like Nationwide, top rated companies. Fidelity and Guarantee, top rated companies. You got Protective. You got NLG. You got companies out there that have top rating companies, and you're gonna see it. They're gonna publicize it everywhere they go. If you ask for a screenshot or a snapshot, hey, can you send me some information about your company? The first thing they're going to post is their ratings, right? They want you to know that we're a strong company. We're here for you.
What's a good rating? Like, is it
Anything A and above. So A
and
minus, A and above, right? Then you
what's
have
the
companies
highest rating?
A plus. Anything in the A's is high ratings. So you
A
got the
plus
Fitch,
plus or
Moody's,
just
yeah,
A plus?
A plus, A plus. There's A minus, A plus, A. You might find a B in there, but then the insurance companies working their behinds to make sure they get that rating up. But that's the biggest thing. Most people are looking for, is this company going to be around? If it's a track record. So when I talk to some clients and say, hey, Mr. and Mrs. Klein, have you heard of, I don't even talk about the product or the company just yet. In fact, I just talk about the benefits, how they work. I'm going to educate my client, make sure they get the differences of, how annuities work, give them a couple options. I'll say towards the end, this company is actually called Nationwide. They're like, I know Nationwide. That's a great company. They're on my side. Exactly. So the unique story here, another thing to look out for too, is you don't want to look for, I don't want to call them mom and pop shops where they only have access to 3 to 4 different kind of annuity contracts, right? You want a company that has, more than 10, 15, 20, because then what do you have? More options, more power, more information, more knowledge, more opportunity for the client to really expand on what exists out there.
I heard that annuities are backed by by whichever state you're a part of. But if is that true or no? Like, are they
I
backed
haven't
by like
heard,
okay,
no.
it could be
Insurance
incorrect
companies,
then.
insurance companies are backed up by the full faith of their ability to stand up on their own feet, and make those promises. So I would hate to have an annuity ran by the state. I
I
would
was
tell you
gonna say
that.
the same thing. When I heard that, I was like,
Yeah,
well, if the state of California is almost bankrupt, how
right.
would that like what good would that be, you know?
What you're talking about are CalPERS, CalSTRS, and CalFERS, or FERS, PERS, and STRS. Okay, They're California design benefit plans that they fund, you fund, California funds, your employer funds. Um, Typically, PERS are for public, FERS are for federal, FERS, STIRS are for state. Okay, so typically these are accounts that if you work for the county, you get public, you get PERS. They just automatically fund your PERS. That's like a giant annuity contract through the state of California that they provide to you, or the city, or the county, whatever it's going to be. But they're pretty much based on their ability to continue, and it's just another benefit. So if I go to a company and they offer me a PERS and I participate in it because it's simple and they provide it for me, it's a no brainer. Go for it, right? But again, they're also ran by the state, so I'm pretty sure that's what you're getting your information from as far as the
Yeah.
government written plans.
How are annuities taxed? Like, how is the income being taxed that I receive, basically?
Just like your old 401k or any other IRA plan or qualified plan. So when you touch it, so let's just say we all know, well, just to kind of clarify, a Roth IRA, you pay taxes now and you'll pay taxes later on. You could put a lump sum of money inside of an annuity, and the income from that annuity, from whatever it grows, is now growing tax free. Okay, you can withdraw tax free. In a 401k, they're all IRAs. It means deferred. They're deferred income, which means you don't tax it now. It can grow as much as it can, but when you start touching that money, you got to pay taxes based on income tax. Income tax is going to be whatever it is that year you decide to start pulling on income, and based on your actual tax bracket and where you're currently at. But yes, an annuity is deferred, and then when you start taking money out of a deferred qualified plan, specifically an IRA or 401k, 403b, TSA, where you defer taxes, you'll pay taxes once you start withdrawing that income.
Got it. So I'm thinking about this like a car. Like, let's say I'm buying a new car. I got
Mm-hmm.
different bells and whistles that I can add.
Mm-hmm.
I could add the nice frames. I can add this. Obviously,
Yeah.
those nice frames are going to cost.
Mm-hmm.
Long-term care riders. That's basically like adding another whistle, but obviously
Mm-hmm.
there's a cost for each one of the riders. What are situations where somebody can get a long-term care rider? And maybe what are some of the different riders available for people as well too?
Mm-hmm.
Long-term care. What are yeah.
Yeah, there's a couple different ones. You can buy, so if we go back into life insurance itself, you can go back into what's called long-term care standalone policies. You can buy a long-term care policy, fund it, and heaven forbid you don't use it, or if you do use it, it's there. If you don't use it, you lose it. Okay. Other accounts like life insurance strategies, for example, I have a life insurance policy and I can add a long-term care rider to it. So let's just say I qualify for a $200,000 life insurance policy. That's what I wanted. I wanted a $200,000 life insurance policy. That's all I needed. I added a rider to it. So the rider is going to pretty much say I can get 2% of the face value guaranteed in income for at least 50 months. So for example, I got a client that just did this. She had a $200,000 life insurance policy. The company's going to pay her 2% of the face, which is $4,000 a month she can use for the next 50 months for anything long term care. That was a benefit for her. Once she exhausted the rider, she gets 10% back as far as a death benefit. Heaven forbid if she needed it. And then there's critical, and then last but not least, there's critical care benefits or ADLs. So you have chronic, critical, and there's also another one called Alzheimer's, right? So if you fall into one of these, like I think I was talking about it earlier, the client that I spoke to that was getting 40 grand a month or 40 grand a year guaranteed, if she fell into an ADL where she could do two of the living benefits, which means if she couldn't eat, if she couldn't bathe herself, if she had no cognizance where she was, if she couldn't get transportation, if she couldn't put her clothes on. There's six of those things. If she couldn't do two of those things, then she would have to wait 60 days and have a letter from a doctor stating that she can't do two of those things, and then we can actually turn that income and double that income in the form of a rider inside of the actual annuity itself. And a lot of these riders don't exist in California. That's why you got to work with a couple individuals that actually have options to give you these riders, because California is very difficult for some of these long-term care benefit riders outside of annuities. But guess what? With the right people and the right help, you can get these riders, and they're all built into the same cost. So that rider that I just spoke about right now, it's still built into 1.01%. So you're paying 1.01% to get guarantees, compounded growth, a guaranteed withdrawal between 7 to 8%. And if you needed it, it'll turn into a multiplier healthcare directive or benefit.
What's the best way for a consumer to actually compare different annuity products? Like almost like like if there was like a document that said this offers this, this offers this, this offers this,
Mhm.
this is what you get.
Yeah, this is where I actually ask a consumer to go ahead and interview. All right, you want to make sure you talk to a couple different advisors if they have opportunities and many options. Some of us have what's called an annuity wizard, or it's pretty much internal, kind of like your MLS, right? Where I can type in what a client needs. I can go to my back office and it populates the top best companies that exist out there. My goal as the insurance person or the person providing the annuity services is to go through the best ones that meet your specific needs. So I wouldn't want to talk to someone that just gave me one option and said, hey, this is the one you fit in. I'm like, no. If I know health is a concern for them, liquidity is a concern, they want higher withdrawal bands, they want to have access to their cash sooner rather than later, and they want some 10% a year liquidity strategies that they can pull out if they needed to, I'm going to incorporate all that into a strategy and find the best companies that actually provide those benefits there. And then obviously,
The best way to do would be to start sharing with different advisors what your ultimate goals are, and then
mhm.
them coming up with different structures for you basically to meet those goals. What is the highest risk in an annuity and what would be like the lowest risk? Meaning like are there certain products that are higher risk than others and
Mhm.
lower risk, and how do we manage the risk?
That's a great question. So, a lot of annuities are designed to be risk adverse, which means they mitigate the fear of losing your money. The only risk you may have is if you want to exercise your right to pull the money out sooner within the surrender. Okay.
That's
So, that
the
means
biggest risk
that's the
basically.
biggest risk. If you need the money sooner, an emergency happens, say, hey, I have exhausted everything. I need this money. Now you're going to pay a surrender. Mind you, if your benefit has key components to say, hey, if you're moving it because of medical purposes, you need to be in the home, you have chronic critical illnesses, guess what? We can waive those surrender schedules as long as it goes to you. If you need the money because you just need the money and pull it out, you're going to pay the surrender and pay regular income tax as if you were taking it out of any deferred account. As far as the most risk would be the surrender schedule and you pretty much exercising your right to pull the money out sooner, okay, because you're paying the surrender schedules. The best situation, you have zero risk, zero fees. Your money compounds and grows. And I guess the risk in between that, let's just say in a couple of years, I had clients early on in my career. I had clients that put money into index annuities, and the strategies were not back tested. They were not. They were kind of like newer strategies. I had clients within 6 to 7 years only make 5 to 8% the whole entire time. So that was a conversation where
So
I've learned
5 to 8%
in 8 years
total in 8 years, so
total,
like a percent a year
total,
basically.
total. So imagine that conversation with somebody and saying, "Hey, listen, 8 years ago we talked about this." But again, you have to really look at the illustration, look at the participation rates, look at how when do they credit the account. Typically, most annuities do a 1 year point to point or a 1 year annual, or they do a 2 year. Okay, when you start getting to the 3 years, now you're waiting because mind you, in the 2 year you get credited after 2 years, in the 1 year you get credited every year. On the 3 year, you get credited once every 3 years. So if you have an annuity contract with a 9 year
There's
schedule,
more risk on that
there's
basically if
there's
it's a
more
3
risk
year.
of you earning nothing. Because let's just say you have
Nothing.
two good years or a good year and 2 bad years, that 1 year is just gone because it just didn't balance out. There wasn't an average they can actually use, especially if it's with indexes that are brand new or don't have a track record. But if you're going with an annuity company that has an S&P index, a gold index, a Nasdaq index, a Barclays index. Those are pretty been around for quite some time, right? You can actually back test those products inside of the annuity itself.
How do you find out the participation? How often they change that as well too? How do you find that out basically?
You call the insurance company, it tells you a back tested record or how long they actually changed their participation rates. Can you give me a list of when you changed them? Some annuity companies pride themselves that we haven't changed our cap rates and we haven't changed our participation rates in 10 years, which is good, right?
Which means
Um,
they're due for one. I'm
They're
kidding.
due for one, or they're consistently good for another call, another 10 years. But yeah, you can look at it both ways. But you
I'm
can look
just
at it
teasing
both
you.
ways. But I would definitely call and then ask for that for the person
Well,
that's working with you.
and that's definitely better than somebody's like, "Oh, yeah, we're changing them like every 3 years or
Yeah.
every 2 years
Oh
or
man,
every so
I'm
often."
telling you. So when I started this business at the age I did, I didn't ask these questions. Experience and exposure, and then you get experience, right? You start asking these questions, you start learning. Hey, the participation rate, was 150% this year, and then 2 years later, now it's at 60%, which means that the market earns 100%, you only get 60% of it, right? So that's not the fairest thing in the world. But again, you want to have control, or at least have an idea that, hey, the caps are not going to change on me crazy, and if they do, I expect the person. So I expect the person that helped me with this product give me a call and do an annual review to make sure we change it. For example, this last week I went over all the clients that I had for that month that I needed to change over and rechange their allocation strategies. I said, wow, this account made 8%, this account made 12%, this account made 0%. Let's take that out. Let's move it to something else, right? So I'm always constantly changing. Or if I see a cap rate changing, I'm changing that outside of it. A lot of people that I see, unfortunately, because in real estate and insurance, you've seen this too. There's a high washout rate, right? There's a lot of orphaned accounts, which means there's accounts that were set up with. I've seen clients that the first person they had 10 years ago put them into a fixed strategy when interest rates were only 1%. I'm like, why were you in a fixed strategy for the last 15 years? That angers me. But the person that sold them the insurance contract, unfortunately,
No longer in the business.
no longer in the business,
Got
right?
paid and bounced.
They got paid in bounds, or they just something happened, adversity, something happened, right? So now I'm taking on a lot of orphan accounts and I'm looking how strategy works. And one thing is like an artist. Jose, you can look at how the contract was written, how a house is designed, how you can actually present this thing and really represent it to your standard, right? I can critique someone else's work when I see how they sold an insurance policy, how the annuity was designed, for why did it need its benefits. You rolled over $25,000 into an income based annuity. Why would someone do that to you? What is $25,000 going to do in 10 years if it's positive returns? It's going to turn into, let's say we're turning it into 50,000, but then you're going to take out 5% guaranteed on 50,000 for the rest of your life. That makes no sense, right?
Not gonna work.
So that means I'm going to guarantee you $2,500 a year every year for the rest of your life, and your money's locked in there, right? Unless you move it out, it's just a whole different thing. So, you can really inspect.
What's the worst thing you've ever seen inside like somebody like happen inside an annuity?
Yeah, the worst thing I've seen is someone that's paying outrageous fees with the longest term surrender. So I've seen a contract where clients are, they're I'll say 50 years old or 55 years old, and they specifically told the client they wanted to move their money by the time they retire because they want to move to another country or they want to be able to have control over it. And I see them put into a 15-year contract. So a 15-year contract, and let's say the surrender schedule is anywhere between 16 and 17%. They're in year 5 of the contract. They want to take their money out like they were told, and then they have a 10-year plus surrender schedule they have to pay for. That is ugly. Another thing is I see clients that go ahead.
And then did that salesperson do it because of a higher commission
It was
or very likely probable, right?
most times they were, or it was something that was pushed, or that's all they knew, or the only products that they had.
Or they just weren't experienced enough to
Yeah,
be able to.
yeah, and I can tell you right now, that's why it's good working with the team. And I said this earlier: you can be a copycat as long as you copy the right cat. And I'm a big believer in that. I want to study before you study someone's fruits. You need to study the roots, right? You need to understand where the industry is coming from, how you can learn, be an individual, learn what you know what you know what you don't know who knows what you need to know. And that's all you need to know. That's what I grew up on when I started this industry. So my whole thing is I'll try to do research. Me and a couple of my business partners, we measure twice and cut once, right? We want to make sure that the client comes back and my proof of work is there, my body of work is there. A lot of agents, they were told to sell something, and then, like you said, they cut out, or they had some adversity, or they got the money and ran, right? So it's always good to talk to people, and then I'll tell you right now too, Jose, there's not a lot of people that have annuities. There's people that know of them. There's people that say, "Hey, what do I do with this money?" The perfect place for someone that has a lump sum money, they want guarantees and use it for retirement after selling a property, might be an annuity. Because, like buying a property, you have zero risk. If the market goes down, you can guarantee, at least that's one thing they're not thinking about. They're getting a guaranteed income with opportunities to grow while they're taking income. They're getting health directive benefits, and they're paying about 1 to 1% or nothing. So those are some of the ideas there.
Yeah. Let me ask you this. What questions would you be asking your advisor? Like, let's say I was your advisor
hmm
and you come to me with your experience. Like, what questions would you be asking me to see if I'm the right advisor for you and I'm the right
hmm
person to help you with this annuity? And to also see, like, if the annuity is the right fit, basically.
hmm I would ask, do you have options for investments, actual investments, right? You're not just going to put me into a fixed index annuity because you don't have the means to get me into another product. Can you do other investments, right? If you have a team that can I do that? Can you do that for me? If you see something suitable that's not out of your scope, can you provide those benefits for me? That's one thing I would ask. Number two, I would want to ask, what's your platform looking like? Who's your company, right? Do you have more than just one, more than two, more than three, more than four flagship products? Do you have a lot of them? Can you actually dig in and find me something that's beneficial for me? And number three, communication is key. You want to make sure everything is, nowadays, Jose, everything is a Google click away. So again, I would always ask someone to go ahead and just type in the name of the product, name of the company, start looking at the person themselves, start interviewing your person that's giving you the advice, and really get into it. At the end of the day, it's really about you doing your work and then they're doing their work, but everything has to be open hand. We're not playing cards here, right? It's only your retirement, Jose. It's only your retirement, right? You have to make sure you're focused on that. So again, I would make sure if they can provide you all the tools you need. Number two, who's their broker dealer, who's their company. Look at the back check record. You want to make sure you look at the Carfax. You want to open up the hood. If it's your advisor or the product, you want to make sure that you feel good and confident. And the last thing is, am I understanding what you're telling me? If I'm talking to you, Jose, and I'm saying, hey, listen, we went over a couple of days of this stuff. I want you to understand, Jose, how this works, and I want to make sure you can play it back to me. Tell me what you purchased. Tell me what you're getting. Tell me the benefits. Heaven forbid you needed it. So at least you know, and I know you know, and we all know that you're in the right place to really help yourself out, put yourself in a place where one, you're getting an annuity, you're getting from the reputable person, you did the back test, and all the products make sense. And I would obviously, if you do get the annuity contract, I would look at reviews, look at what's online, see what's happening, start doing some back testing yourself. But again, it all comes down to trust as well, and knowing the person you're doing business with. I think that's a big deal.
I love
And
it.
both, and last thing, Jose, both you and I know, we're not in the financial services business. We're in the behavior business. We're in the people business. I could look at someone's behavior on how they treated money, and look at their retirement portfolio as a scorecard or a report card. My goal is to turn that report card and change those C's into B's, A's into better A's, and then get better marks on their portfolio by me putting the right stack in front of them and making sure I'm listening and doing my due diligence when it comes to coming back with some advice.
If somebody enjoyed this interview and wanted to get in contact with you, what's the best way for them to do that?
It's a great question. My email is Joe dot Yniguez at ilnagency.com. And my direct number is 805-415-7525. I'm not sure if leaving your phone number is appropriate, but
It
again,
is.
it's going to be my last name, Joe.Yniguez at ilnagency.com.
How long have you had the same number?
We talked about this earlier. Yeah, I've had the same number since sophomore year of high school. I had the
I
little
love it.
Nokia brick phone, and we talked about having the same
Yeah.
phone number for the last 20 some odd years really says something about your ability to stay in business and be in business and be really serious about your character and how there's people that change their numbers for different things, but I'm really proud I had my same number for the last since high school.
I think that's a good metric. I've had my number for a really long time as well
Yeah.
too. So I want to say thank you for coming on the show, Joe. Today we talked about what is an annuity and how does it work. We had Joe Yniguez talk with Impact Leadership Network. We answered a lot of questions. We talked about like the pros and cons. We talked about variable, index, immediate, deferred. This is such a deep topic, but I wanted to just shed a little bit of transparency for clients out there considering annuities. If you saw enough value, reach out to Joe. Once again, thank you, Joe. To our viewers, until next
No,
time.